UK house prices have fallen at the fastest rate since 2009. That's the headlines in the press after the latest Halifax House Price Index report was released. So are we really facing into a financial crisis-style market crash where millions of people are affected? Are now the early warning signs that a bigger housing market decline is on the cards, just like many people have speculated? Or is it perhaps not as bad as it's being made out? Well, despite councils going bankrupt this week, which completely isn't relevant for this video, it just highlights the shit show that is the UK government.
I don't think that's the case.
In today's video, what I wanted to share was the latest house price data. I'll share my own thoughts along with the future forecast too. Be sure to share your thoughts down in the comment section below. So here's the report. The headline numbers are the average UK house price is now £279,569, which is a 4.6% decline from the same time last year. In nominal terms, this accounts for an average property value decline of £13,456. Now, the Halifax Mortgage Director has commented that it's fair to say that house prices have proven more resilient than expected so far this year, which is a positive thing, despite higher interest rates weighing on buyer demand. However, there is a lag effect where interest rates are concerned, and we may now be seeing greater impact from higher mortgage costs flowing through to house prices. And look, I think he certainly makes a valid point. There are over 1.4 million fixed rate mortgages due for renewal in 2023, and there's another 885,000 due for renewal by the end of Q3 2024. That's over 2 million mortgages that were up for renewal on rates that were lower than 2.5%. Now, with the lowest 2-year fixed rate on the mortgage right now being 6.19%, it means that the average cost of your average price property at a 90% loan to value would go from £1,068 per month with a total debt repayment of £320,000 to £1,653 per month with a total debt repayment of £495,000.
That's crazy talk!
In percentage terms, that's a 54% increase in your monthly mortgage payment, which hundreds of thousands of households are going to certainly feel the pinch of over the next 12 months.
I've got nothing left!
So, as the Halifax director said, yes, there is certainly a lagging effect on the change in interest rates today and how that's actually going to affect house prices in the near future. He goes on to say the market will continue to rebalance until it finds an equilibrium, where buyers are more comfortable with mortgage costs in a higher range than we've actually seen in the past 15 years. So whatever that equilibrium point is, whether it's a 5% decline, 10% decline, or 20% decline, it will inevitably be dictated by the affordability of the market, which is obviously based on more than just the interest rate factor, which we'll touch a little bit more upon later on in the video. But I think what's important to note is that the report says that you should expect further downward pressure on property prices through to the end of this year and into next, in line with previous forecasts. And just as a quick segue, those forecasts were actually an 8% decline in house prices through 2023. Further to that, it says while any drop won't be welcomed by current homeowners, of course, it's important to remember that prices remain some £40,000 or 17% higher than pre-pandemic levels. So there's two important points that I want to call out here. Firstly, house prices have been massively inflated over the past couple of years or so. And in reality, it's probably not a bad thing that those prices taper off just a little bit, so the price to income ratios on them aren't so insanely high. The second point that I want to call out, which will probably surprise you guys, is despite the doom and gloom headlines that you've seen in the press, actually house prices as at so far this year are only actually down 1%. We started the year off with average house prices of £282,000, and as of right now, they're only £279,000. So despite being led to believe that a Bank of England induced bomb has just hit the housing market, it's perhaps not quite as it seems, or at least depending on your overall perspective and opinion. Some people who watch BBC News will believe it's an absolute disaster, whilst others probably see it as an opportunity. Which leads me on to talking about today's video sponsor, which is Lendlord. Now, Lendlord are a property management platform that I use to manage my own investment property and where I look to analyse future property deals using their deal analyzer tool. So let me show you around the platform. So if I come over to the My Portfolio tab, you can see the high level details of my own personal investment property. Now you can add so much information into here, such as your portfolio information. You could add details on the tenants, you can add payment schedules, you can also look at insights on the individual property investments that you've made, along with add all kinds of documentation in here, from tenancy agreements right the way through to EPC certificates and everything else in between. It really is a full end-to-end property management solution which removes the need for needless Excel spreadsheets because it can be all tracked all in one place, which is obviously great for all of you existing landlords out there, but for those of you who are new and aspiring landlords, what I wanted to show you guys in order to help you get started is the Deal Analyzer tool. So to do this, I want to go into the Invest tab and we're going to look at some on-market properties. For the purpose of example, I want to look for a property, say in Manchester, and I want it to be, let's say, within 3 kilometers of Manchester, and my maximum budget that I have for this property is, let's say, £150,000. Now from that, you can see there are 6 properties available where you've got all of the information from the guide price through to rental analysis, through to flip analysis if you wanted to flip the property, right the way through to potentially getting finance options in order to purchase it. If you click into it, you can then see some information on the rental and flip analysis. Now, let's just say for the purpose of this, we want to look to rent the property out and keep it. Now, from that, you can see you got all of the details, all of the metrics on the property itself, which can help you make a decision as to whether you want to view it and then potentially put an offer in on it. Now, first year metrics are, of course, something to consider, but probably the most important metric is the longer term returns, which as of right now sit at 278.84%. So if you're interested in this property management software, then I'll leave a link down in the description below where you can sign up for a completely free account. Now, one thing that I did want to touch upon with you guys and just provide my perspective on is that looking at house price data, and specifically average house price data, can be somewhat misleading. Where I have a slight problem is that applying a catch-all piece of analysis in order to determine the whole performance of the UK property market probably isn't quite accurate, especially when that's the thing that we read in the headlines.
He's full of shit!
Because of course, region to region obviously differs. If we look at this data from the Office of National Statistics, actually most regions have seen house price growth in the past 12 months rather than declines, with London being the only area where a decline in value has actually been logged. Firstly, this doesn't quite line up to the Halifax House Price Index report, but regardless, the point that I really want to labour on here is that different geographical locations will be affected differently by different economic events. For example, where I live in the Midlands, actually within about a mile radius of where I live, house prices haven't really changed this year compared to last year. In actual fact, they're probably a little bit more expensive. And that's with me being an active buyer in the market since the middle of last year, so I've certainly been keeping abreast of the property market, at least within my local area. I'm not sure if you guys are seeing the same thing in your area, but at least for me, based on my perspective, the picture kind of seems a little bit incomplete.
Something smells fishy.
So let's talk about the future of interest rates, because ultimately they're the driving force behind the underlying value of the property market. And of course, right now, interest rates are being driven by inflation. Now, in August Monetary Policy Committee, the Bank of England published this chart. It's the forecasted inflation rate, which they expect to continue to decline, but they're not expecting to be back at the 2% target rate until Q1 2025. This could mean that rates stay higher for at least the next 12 to 18 months. And at best, we'll probably only start seeing marginal rate cuts as we move closer to that 2% target. So in light of that, here's the forecasted interest rate chart. Now, the blue dashed line was what the market forecasted for interest rates back in May, expecting a rise of the central bank rate to about 5%, then to be back down at about 3.5% within a couple of years. However, now the solid dashed line, which is the current forecast, paints a very different picture. It shows forecasts of a terminal rate of about 6%, so another 75 basis points higher than where we are right now. However, to give you guys a little bit of comfort, the Bank of England Governor Andrew Bailey came out just yesterday and said that we are nearing the top of the cycle. So hopefully we won't see rates go any higher than what they're forecasted to be currently. But thereafter, the forecasts do suggest that rates will start to taper off into 2025 and 2026, where we'll see rates back below 5% again. But it does more than likely mean that we'll see rates in and around the realms of about 4.5% for the next 3 years. So what exactly does this mean? Well, unless you manage to get yourself some kind of 10-year fixed rate mortgage product at a couple of percent interest, the chances are at some point in time you're probably going to feel the pain of this interest rate hike cycle at some point in the next couple of years as your fixed rate mortgage comes to an end. As a result, it will inevitably put pressure on affordability.
I'm poor now.
which I think inevitably will result in house prices tapering off if, and this is a big if, incomes don't actually remain static or potentially increase. Right now, real income growth is projected to stay positive, but it is coming under increasing pressure as the year moves on. So look, we're in a very different phase of economics right now for the UK population. One we will all inevitably have to get used to, being in this higher interest rate climate. So with that in mind, with rates being high, it's not all doom and gloom, especially for all of you savers out there that can now get a good interest rate on your bank accounts. So if you want to know how to maximize your money in today's current climate, along with looking at the debate around saving versus investing and which one is the most beneficial to you, then be sure to click on this video next. And with that being said, see you over in the next one.